Hello and welcome to today's session, Agribusiness Industry Tax Credits and Incentives. We're pleased that you've joined us today. And before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have two speakers with us today from Moss Adams. We have Adam DeZego, Director, and Ben Alderton, Senior Manager. Their bios and contact information are located in your webcast console. Also, you do have the option to submit questions for these presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And now I would like to turn it over to Ben to get us started.
Thanks, Amy. So as we indicated, we wanted to go over some credits and incentives and especially spend a good bit of time as it relates to the Inflation Reduction Act and some opportunities that have really come about and some changes in opportunities for credits that did not exist before. So the Inflation Reduction Act created an unprecedented opportunity for transitioning to green energy in manufacturing. It created a 10-year lifespan for credits associated with green energy and green manufacturing. And original estimates were $370 billion over the 10 years. We think it's going to be much, much larger than that ultimately. Additionally, federal law has historically prohibited the transfer of these credits unless it was done through what's called a tax equity structure or partnership flip, you sometimes hear it referred to. And the Inflation Reduction Act kind of changed all of that and allowed for the transfer of certain energy-related tax credits under Internal Revenue Code 6418 for investment tax credits or production tax credits. And this transfer mechanism greatly simplified the process as it relates to being able to utilize credits and transfer those credits to third parties that may have the tax liability to actually utilize the credit. We're going to focus on just a few of the credits. I think there's 12 or so credits that were created or extended through the Inflation Reduction Act. We thought we would just focus on a few of them today. There are probably some others that you may have some interest in, but the ones we're going to primarily focus on are related to IRC Section 30C, which is the alternative fuel vehicle refueling, which is essentially EV charging stations, the production tax credit, and the investment tax credit. And each of those credits has various different credit enhancements that go along with the generation of the credit. There's a base amount, and then they can be increased or enhanced depending on if you meet each one of these eligible enhancements. And we'll talk about each of those enhancements here in just a minute. Additionally, it created the opportunity to carry forward and carry back credits. And then, as we talked about already, these credits are transferable. So one of the things we wanted to talk about, we're going to spend some time on talking about investment tax credits and production tax credits. And there's really some key differences that are associated with each of these two types of credits. They're both related to green energy, so think solar, wind, battery. We typically will reference maybe solar or wind. And if you can pick one or the other, an investment tax credit or a production tax credit as it relates to that energy facility. So an investment tax credit is based on the qualified cost of the eligible property, such as the solar panels that go into it, or if you're talking about wind turbines, the wind turbine and installing that turbine, et cetera, et cetera. The eligible credit percentage can range from a base of 6% to as high as 70% if you meet all the various enhancements that are possible under the Inflation Reduction Act. And again, the next slide will kind of walk through these enhancements and what those look like, but it can go as high as 70% if you were to sort of check each and every one of those boxes as you go along. The credit is also available in the tax year when the project is placed in service. So if the solar panels are installed in 2023, it is a 2023 tax credit. And then there's also a 5-year recapture period that's associated with those credits. So the facility needs to remain in service for a minimum of 5 years during that compliance period. The flip side of that coin, or the other incentive that's related to it, is the production tax credit. Production tax credits are based on the production or sale of a manufactured product, or such as energy, such as electricity for a wind turbine or a solar panel. Certain renewable energy equipment can be manufactured, such as maybe the turbines themselves, and sold to it. And then that electricity or product is then sold to an unrelated third party. These credits are generally earned over a 10-year period based on the production or the sale of that energy or component. And what's different here as well is that there's no recapture of the credit. It's earned because it's earned based on the production or sale of each product or electricity during the course of the year. So that's kind of a key difference that you will see between the investment tax credit and the production tax credit. This next slide shows the various types of enhancements that are possible under the investment tax credit. So here we're talking about that ITC that has a base credit, as we indicated earlier, of 6%. And then if you meet what's called prevailing wage and apprenticeship requirements, you can jump that credit from a 6% credit to a 30% credit. And what it is paying wages that are, if you're familiar at all with the Davis-Bacon wages as it relates to federal contracting, it's the same concept there. It's paying prevailing wages within that region in which the project is being built or manufactured. And so if you meet that percentage, or you're exempt, there's an exemption for projects that are under 1 megawatt in size, or they began construction prior to about January 28th, 2023, then you don't have to meet the prevailing wage and apprenticeship requirements, and you automatically have a 30% credit. The next kind of enhancement that exists is a 10% bonus for meeting domestic content, and that's by USA. So 100% of the steel and iron that goes into the solar panels, for example, if we're talking about solar or whatever the product is, has to be manufactured in the United States. And then it starts at 40% and ratchets up to 55% of the manufactured products have to be manufactured in the United States. So you've got the steel or iron, maybe, that is the base of your solar panel. That has to be 100% sourced in the United States. And then the solar panels themselves need to 40% of the products that go into those solar panels need to be manufactured in the United States. And it does go up. It starts in 2025. It goes up to 5% a year, from 40% to 55% of the manufactured product. But if you meet the prevailing wage and or exempt prevailing wage and then meet domestic content, you're now at a 40% credit instead of a 6 or even 30% credit. The next enhancement is a 10% bonus for being located in an energy community. You can be located in an energy community in one of 3 ways. One is as it relates to census tracts or adjoining census tracts where there's been a coal-fired generation power plant that has closed within a certain period of time. Or if there's historically been a threshold number of employment related to the energy, related to oil and gas production, essentially, plus a higher than average unemployment rate. That is another way that can classify as an energy community. And then the last way is based on what we call the brownfield requirement, or brownfield qualification, that the project is either located in a brownfield or has evidence of or suspected environmental contamination. That then, if you meet any of those, then you jump up another 10%, or theoretically get you from 6% in that case all the way up to 50%. The last two enhancements are kind of lumped together there at the top of the page. Those are related to the environmental justice allocation for projects that are located in a low-income community or on tribal land, or are associated with and provide benefit to the low-income community. So solar panels installed on an affordable housing complex, for example, might qualify for that additional bonus at the top there. The difference between all the other adders that we've talked about and the environmental justice adders is that this actually requires an application process. You're not, as of right, granted the additional enhancement. You actually have to apply for that enhancement and be awarded a portion of the allocation that's available each year. The Department of Energy is helping run this program for the IRS, and they announced just recently that on October 19th, the next round of the initial round of applications will be available, and you can start applying for those additional enhancements at that time. This is the same sort of graph or same sort of picture as it relates to the production tax credits and the enhancements that can come from the production tax credit. So with the production tax credit, there's a base amount in 2023. That amount adjusted for inflation was $5.50 per megawatt hour of electricity that was produced. And then there's, if you meet the same prevailing wage and apprenticeship requirements, or you're exempt because your facility is less than 1 megawatt or began construction before January 28th of 2023, then you're exempt and you qualify for that 5 times adder, or an additional $22, bringing it to $27.50 per megawatt hour. And likewise, we have an increase related to domestic content. And then if you're located in an energy community as well, you can qualify for that additional enhancement there as well. So you can take the $5.50 base credit, and if you were to meet all of these additional enhancements, it jumps to a $33 per megawatt hour credit that can be generated. So quite a large difference on both the PTC and the ITC credits. With that, I'm going to turn it over to Adam to take us through some of the transferability.
Thanks, Ben. With the background of the programs in mind, Ben and I wanted to spend a minute discussing transferability, since this is really the first time we've had a federal tax credit that could be transferred from one party to another without having ownership in the entity that is generating the credit. Transferability is fairly common if anyone is aware or familiar with state tax credits. Generally, the transfer of the credits is treated as a capital asset sale, and you use this asset to offset your tax liability. With the efficiencies that we see in the state market, it appears the federal government might have wanted to steal a page from this playbook to try and mimic the straightforward approach for the transfer of federal credits. Transferability applies for clean energy projects that were placed in service on or after January 1st, 2023. One limitation to note, however, is that there is a one-time election to transfer, but that can be for all or a portion of the tax credits that have been generated. To add a bit more clarity to this, a seller can transfer the entire amount of the credit to one purchaser or sell portions of the generated credit to multiple buyers. This transfer to a third party must have cash consideration in all cases. Proceeds are not part of the taxable income of the transferring party, nor can they be deductible by the transferee. But as described in the third bullet on the slide, the gain on the discount is not taxable for the buyer. For example, if you purchase a credit at 93 cents, the 7-cent delta between the purchase price and $1 is not taxable, meaning you have a before and after tax return equating to approximately 7%. The transferee will be able to use the credit the same way as the transferor would have. You can carry back 3 years and forward for 22. As a seller of the credit, you have until the due date of your return, including all extensions, to make this election. And finally, the transferee is subject to recapture from a purchased ITC. Therefore, it will be common to not only have a sponsor guarantee for this risk, but also tax credit qualification and recapture insurance to cover any risk of loss associated with your purchase. In looking at transferable tax credit opportunities, there are several considerations that must be taken into account, and we attempt to highlight a few of the more significant ones here. For corporations, transferable credits can offset the new global minimum tax, and since the credits under the Inflation Reduction Act are considered general business credits, there is a limitation that your liability can only be reduced by up to 75%. For closely held C Corps, S Corps, and individuals, passive activity rules appear to still limit usage, but we are still awaiting final guidance from the IRS to confirm this position. Each individual state taxing jurisdiction will have the ability to determine whether or not they will conform to the federal position, but since they rarely take non-conforming positions, we expect that the state treatment will mimic federal. Finally, if a buyer can show intent, they can consider potential acquisitions when calculating their estimated payments, even before a transaction closes and credits have been transferred. However, if there is any shortfall in a purchase, a buyer might be subject to underpayment penalties and interest. For the next 2 slides, Ben and I thought it might be best to try and distill the major steps of the credit transfer process for both the buyer and the seller into a visual aid. As you can see, for the seller, we were able to silo the major steps in the process into 4 major categories: credit generation, buyer identification, credit registration, and finally transfer. As sellers, certain tax credit characteristics will impact the matchmaking with a potential buyer. Fundamentally, whether your credit is an ITC or a PTC, as well as the enhancements that have been utilized, this will all impact a buyer's sentiment. Additionally, how flexible you can be with price, payment terms, and various recapture protections will also impact the marketability of your credits. One item to point out is that we're still awaiting final guidance from the IRS on the exact procedure of the tax credit registration and transfer process. While we do have proposed regulations and some idea of what this portal will look like, it has not yet been released, and we hope that we're going to see something in the next few weeks, but there have been some recent grumblings that we might be waiting a little bit longer than that for insight into what the registration and transfer process is going to look like from a portal perspective. As buyers, determining your eligibility and the amount of the credit that can be used is likely the first threshold to clear. Once these items have been determined, the evaluation of various opportunities will be the next step. Certain characteristics will inevitably guide the decision-making process. These might include such items such as energy technology, whether it is an ITC or a PTC, price, payment terms, the strength of the guarantor, and or the presence of tax credit insurance, as well as the various credit enhancements that Ben went through earlier that will play into the value of the credit being transferred. While we lay this out as somewhat a linear process, by no means is it a straight path, but as discussions are had, trends will emerge, and certain characteristics will inevitably rise to the top as being more important than others. So kind of shifting gears slightly, a topic that is likely familiar to many in the audience is the Employee Retention Tax Credit. This credit allows employers that experienced a partial shutdown due to government orders limiting commerce, travel, or group meetings, or that experienced significant declines in quarterly gross receipts as compared to that of 2019 are eligible employers underneath this program. The ERTC is a refundable tax credit for qualifying employee wages, Therefore, the credit is based on payroll taxes rather than income taxes. So a qualifying business can still receive the credit even if they did not pay income taxes in 2020 or 2021. The ERTC can be as high as $5,000 per employee in 2020 and as high as $28,000 per employee in 2021. Also note that this is a credit and not a loan, therefore it will not need to be paid back to the government by the qualified employer. And for most taxpayers, the refundable credit is more than the payroll taxes in any credit generating period. A question has come up about whether or not you can still apply for the ERTC. The simple answer is yes. The statute of limitations for the 2020 ERTC does not close until April 15th of 2024. Corollary to that, the statute of limitations for the 2021 ERTC being a year later, those limitations do not close until April 15th of 2025. So plenty of time. So if you are an organization that might have experienced a decline in gross receipts or are limited in doing business by state or local government orders, should be eligible for filing a claim under the ERTC. Even if you might have looked at this opportunity previously, it might be worth a revisit because with experience, everyone has become more adept at qualifying partial suspension claims for taxpayers. One last point, you might have heard recently in the news that the IRS has temporarily suspended the processing of new claims through at least the end of this calendar year. The short answer here is that Moss Adams doesn't believe that this is an issue for valid claims, and we continue to process them for clients. For taxpayers who qualify for the ERTC, you should still continue to file claims, but just with an awareness that the IRS and those processing times may extend beyond current expectations. So with that, Amy, it looks like we might be back to our polling question, so I'll pass it back to you.
All right, thank you. So the polling question is located right on the slides that we're presenting. So if you can't see it, just hit F5 to refresh your console. But the question is, I'm interested in learning more about, and then you can select all that apply. A, qualifying for credits under the IRA. B, transferring credits under the IRA. C, buying federal tax credits under the IRA. Or D, qualifying for the employee retention credit. Or E, just here to learn. And to respond, you're going to click the button next to the answers that you choose and then make sure to hit submit. All right, we'll leave this up another 5 seconds or so. All right, here you go, Adam.
Great. So it looks like, we had a nice dispersity in the responses here. It looks like we did have a lot of people that were just here to learn, which is great. But also it looks like we did have some interesting questions or people interested in learning just more about the IRA opportunities that are available. Ben, thought I might throw it over to you with the question. If you wanted to, I know we had talked a little bit about this previously, but would you like to talk a little bit, since we didn't really get involved in depth in our kind of comments about pricing as it relates to what we're seeing in the market? Do you want to field that question and maybe provide a little insight into what we're seeing currently?
Sure, happy to do so. So that's a great point. So one of the things we didn't touch on was pricing. So one of the questions that we've had asked before is like, what are the pricing for these transferable credits? What's that look like? And so it really depends a little bit on, there's a little bit of a difference between ITCs and PTCs, as we indicated, with the production tax credit being based on the production of the electricity or manufactured product. It might be more valuable because it has less recapture risk. But in general, the market is somewhere in the mid-90s, essentially, low to mid-90s for both ITCs and PTCs. I think 93 to 95, 96 cents at the high end. And you are seeing there may be other opportunities that exist in the market. A lot of, as Adam indicated, there's a preference for insurance that does have a cost for it. So if there's not insurance associated with the transaction, it may have a little more risk. There may be a pricing advantage there. It's just really kind of variable. But that's kind of where we're seeing the market at this point.
That's great. Maybe just one other comment I thought I'd mention, because we do field in our group this question quite a bit, is it looks like there are kind of where we're at just sitting October 5th, is that, buyers or even sellers sitting there, you're really looking at and running parallel paths as it relates to 2023 and 2024 opportunities. 2023, is shaping up most of the time just with the guidance and the late start that we got, and with clarity from the IRS. We did see that, with that delay, investors were not necessarily jumping into the market. They were still making estimated tax payments. So there is still a lot of negotiation for 2023 credits as we see it today. But there's also this kind of ancillary approach that people are really trying to get out in front of their 2024 items, whether it's for sellers to kind of lock up those agreements in order to secure financing for construction, or on the buyer's side, just so they can have an agreement in place to really, forego or completely eliminate certain estimated tax payments as we run through the year. So I think that's what, just a market trend. Not only are there various characteristics that impact pricing and what you might see, but price for credit, but you also have this idea of what year or years you're really looking at. And I would even say in certain instances, we're seeing, maybe on the PTC side, especially 5 or 10 year commitments with someone that has a pretty stable tax liability to maybe generate a little additional savings. They're willing to commit more than 1 year at a time. Amy, with that, I guess, I don't really see any questions in the box that we haven't addressed, but I don't know if you see differently. If not, we might have a little bit of time left, or you can go ahead and wrap us up.
Yeah, I think I'll get us wrapped up here. But thank you, Adam and Ben, for a great presentation and for your time today. To our audience, if you have further questions or comments, please reach out to us, and we would be happy to continue this conversation. You can drop a note in the Q&A window or reach out to Adam or Ben directly. Their contact information is in your console as well as in your slide deck, which you can download now from the handouts window. And finally, here's a link to a survey for today's presentation. Your feedback is appreciated, and thank you for joining us. Take care, everyone.